What's up, traders, and welcome back to Explain the Charts. Today is October 1st, 2025, and we are diving deep into one of the most watched currency pairs, the US dollar versus the Japanese yen, or USDJPY. We've seen some dramatic moves recently, so we'll break down the crucial news driving the market and then jump straight into the charts to identify key levels and potential trade setups. There is a perfect storm of fundamental factors brewing right now, heavily weighing on the US dollar. First and foremost, the United States is dealing with a government shutdown, which is creating significant economic uncertainty and halting the release of key macroeconomic data. This has led the market to increase bets that the Federal Reserve will be forced to cut rates, possibly as soon as their next meeting. Compounding this dollar weakness is a series of lackluster employment reports. The latest ADP National Employment Report was a huge shock, showing the private sector shed 32,000 jobs in September against expectations of a 51,000 job gain. This is a major sign of a cooling labor market, which further supports the case for the Fed to ease its monetary policy. Meanwhile, on the other side of the pair, the Japanese yen is catching a bid. The Bank of Japan has been striking a more hawkish tone, with recent meeting minutes revealing that some policymakers actually voted for a rate hike. This has fueled speculation that the BOJ may finally be ready to move away from its ultra-dovish stance, which is inherently bullish for the yen. Adding another layer of complexity, today marks the start of new U.S. tariffs on various imports, a move by the Trump administration that could introduce fresh volatility into the markets. So, we have a fundamentally weak dollar story clashing with a strengthening yen story, which explains the recent sharp drop we've seen in USDJPY. Now, let's pull up the daily chart and see how this narrative is reflected in the price action. Looking at the big picture on the daily time frame, we can see a significant period of volatility over the past year. After peaking above the 161 level back in July of 2024, the pair experienced a massive sell-off, finding a major bottom right around the 140.00 handle in early September 2024. That 140 level is a huge psychological and technical support area to keep in mind. Following that low, the market staged a multi-month recovery, methodically grinding its way higher. The price action eventually brought us all the way back to test the 150.00 psychological resistance level just last week. However, as you can see from these last four candles, that level was decisively rejected. The price has fallen for 4 consecutive days, perfectly correlating with the negative U.S. data and government shutdown news we just discussed. This recent drop has broken below a key technical level that many traders were watching, the 148.50 support. What was once support often becomes new resistance, so we'll be watching 148.50 very closely on any potential bounces. Let's zoom in to get a clearer view of this recent breakdown. Here we can see the price action from the beginning of September until today. Notice the strong push-up to just shy of 150, followed by this aggressive reversal. The size and momentum of these recent bearish candles suggest that sellers are currently in firm control of the market. The immediate question for traders now is whether this bearish momentum will continue. The next major support level identified by analysts is a major rising trendline around the 146.50 area. This level also coincides with lows we saw back in August, making it a significant confluence of support. A break below the current lows around 147.60 would likely open the door for a test of that critical 146.50 zone. Now, let's switch to the 15-minute chart to get a feel for the very short-term price action. On this intraday time frame, we can clearly see the sharp downtrend of the last few days. You could draw a steep downward trend line connecting the recent highs, which has been acting as dynamic resistance. Sellers have been using this trendline to initiate short positions on any minor rally. Over the last several hours, however, the price has started to move sideways, building a small consolidation range. The low of this range is around 147.65, and the high is just above 148.00. This type of consolidation after a strong move is very common as the market digests the recent news and waits for the next catalyst. That catalyst is coming very soon, with the USDJPY and ISM manufacturing PMI data due out later today. For short-term traders, a break below this consolidation range could signal a continuation of the downtrend. Conversely, a convincing break above the range and the short-term descending trend line might signal a temporary bottom is in, leading to a larger corrective bounce. But given the strong fundamental headwinds for the dollar, the path of least resistance currently appears to be to the downside. Let's go back to the daily chart to recap and formulate a game plan. To summarize, the fundamental picture is decidedly bearish for USDJPY right now. We have a weakening U.S. economy, a potential government shutdown-induced recession, and a Fed poised to cut rates. At the same time, we have a Bank of Japan that is hinting at tightening its own policy. This policy divergence is a powerful driver for currency markets. On the technical side, the price has broken key support at 148.50 and is in a clear short-term downtrend. So let's outline the key price levels to watch. Your immediate resistance is the bottom of the old range, around 148.50. A move back above this would be the first sign of strength. Above that, the major psychological and technical resistance sits at the 150.00 handle. To the downside, the next major support target for sellers is the trend line and prior lows around 146.50. If that level breaks, we could see a much deeper correction towards the 143.00 handle. And the ultimate floor for this pair remains the multi-month low at 140.00. Now for some potential scenarios. A bearish continuation seems the most likely path, and I'd put the probability at around 65%. This would be reinforced by more weak U.S. data today and throughout the week, especially a poor NFP report on Friday. Under this scenario, we would expect a break of the current intraday consolidation, leading to a test of 146.50. A bullish reversal scenario has a lower probability, perhaps around 35%. For this to happen, we would need to see surprisingly strong U.S. economic data, causing the market to price out some of the expected Fed rate cuts. The first technical signal for this would be a break and hold back above 148.50, which could trigger a short squeeze rally towards 150.00. The main thing to watch for today are the USDJPY and ISM reports. The market's reaction to this data will likely set the tone for the rest of the week. Also, keep an eye on any headlines related to the government shutdown or statements from Fed officials. Thanks for watching our analysis of USDJPY here on Explain the Charts. Remember to trade smart and manage your risk. Finally, a quick disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. All trading and investment decisions should be based on your own research and risk tolerance. Good luck, and we'll see you in the next video.